third topic is about monopolistic competition. Monopolistic competition characteristics. Many firms, similar but differentiated products, like restaurants, clothing brands. Non-price competition, such as advertising, branding, is the only way to gain pricing power and sustain profits long term. Low barriers to entry mean profits are eroded over time, but differentiation helps delay this. Perfect competition characteristics. Many firms, identical products, such as wheat, water, no differentiation, no pricing power, firms are price takers. Advertising is useless because products are the same. Oligopoly characteristics. Few firms, products may be differentiated or similar. For example, smartphones, airlines. Non-price competition, such as advertising, features matters, but firms also compete on price. Profits depend on strategic behavior, such as collusion, game theory, and high barriers to entry. For example, patents, scale. Unlike perfect competition that has no differentiation, or oligopoly that profits rely more on barriers or strategy, monopolistic competition requires differentiation to survive. For example, a local coffee shop can charge more than Starbucks if it builds a loyal customer base through unique vibes, better service, or organic ingredients, even though competitors are nearby. Oligopoly firms can differentiate, but their profits are also protected by barriers to entry. Monopolistic competition firms rely on differentiation since barriers are low. Key features of monopolistic competition. Many sellers. No single firm controls the market. Product differentiation. Each firm's product is unique, such as brand, quality, design, giving it slight pricing power. Free entry or exit. Firms can enter or leave the market easily. Low barriers. Having many competitors, each following its own product differentiation strategy, is the defining feature of monopolistic competition. Firms compete by making their products unique, such as Nike versus Adidas shoes. Option A is incorrect. In monopolistic competition, new firms enter if profits exist, driving prices down until profits disappear. Zero economic profit in the long run. Option B is incorrect. Supply curves are only clear in perfect competition, where firms are price takers. In monopolistic competition, firms set prices based on demand and differentiation, not just costs. Perfectly elastic demand means firms are price takers. Any price increase loses all customers. This happens in perfect competition, not monopolistic competition. In monopolistic competition, firms face downward sloping demand. They can raise prices without losing all customers due to differentiation. Fourth topic is about oligopoly. A Nash equilibrium occurs when neither airline can improve its profit by unilaterally changing its strategy. Option A, both maintain prices. If airline 1 switches to lowering prices, its profit jumps to 50 million, better than 40 million. So, airline 1 would want to change its strategy, not a Nash equilibrium. B, airline 1 lowers, airline 2 maintains. Airline 2 sees its profit is 20 million. If it switches to lowering prices, its profit rises to 25 million, better than 20 million. So, airline 2 would want to change its strategy, not a Nash equilibrium. Option C, both lower prices. If airline 1 switches to maintaining prices, its profit drops to 20 million, worse than 25 million. If airline 2 switches to maintaining prices, its profit drops to 20 million, worse than 25 million. Neither airline wants to change its strategy. This is a Nash equilibrium. The only stable outcome is option C, both lower prices. Industry X. Products are identical, homogeneous, no barriers to entry or exit. This matches perfect competition, not oligopoly. Industry Y. Products are differentiated, such as branding or marketing. Each firm has a downward sloping demand curve, slight pricing power. This matches monopolistic competition, not oligopoly. Industry Z. Few large firms dominate the market. One firm's output decision affects rivals' pricing or output. Interdependence. This matches oligopoly. Only Industry Z fits the definition of an oligopoly. In an oligopoly, firms are interdependent. They watch each other's moves. If a firm raises its price, rivals won't follow. They keep prices low to steal customers. The firm loses market share. Demand is elastic here. If a firm lowers its price, rivals match the cut to avoid losing customers. The firm gains little extra market share. Demand is inelastic here. This creates a kink in the demand curve at the current price. The kink leads to a discontinuous marginal revenue curve. Even if marginal cost shifts up or down within this gap, the profit maximizing price and output don't change because MR equals MC still holds at the kink. Thus, prices stay stable unless costs change drastically. Option A explains asymmetric reactions. Rivals don't follow hikes but match cuts. This is correct. Option B is incorrect. The model assumes no collusion. Firms act independently, not together. Option C is incorrect. Firms do not assume rivals' output is constant. They expect rivals to react strategically, such as match price cuts. Kinked demand curve is price rigidity. Prices don't move easily because firms fear losing customers if they raise prices and gain little if they cut them. Unlike non-cooperative models such as cartels, no collusion needed. A smaller firm tries to set a price slightly below the leader's price to attract customers. The dominant firm can retaliate by lowering its price even further, since its costs are lower. At the new lower price, the dominant firm still makes a profit or breaks even. The smaller firm loses money because price is less than its costs. On the long run, the smaller firm can't sustain losses, so it either exits the market or raises prices back to the leader's level and loses the customers it tried to steal. Either way, the dominant firm's market share increases. Customers switch from the failed smaller firm to the leader. The dominant firm has the lowest costs and sets the market price. Smaller firms follow because they can't compete on cost. They would lose money if they matched the leader's low price. This is price leadership. Fifth topic is about determining market structure. HHI is the sum of the squares of each firm's market share. For example, firm A's share is 30%, so 30 squared equals 900. Higher HHI means more concentrated. Fewer firms dominate. Lower HHI means more competitive. Many firms share the market. Total HHI here is 2,150. Unconcentrated is HHI is lower than 1,500. Many firms, no single firm dominates. Moderately concentrated is HHI is higher than 1,500 and lower than 2,500. or equals to 1,500 and not more than 2,500. A few firms have significant power, but competition exists. Highly concentrated is HHI is more than 2,500. One or two firms dominate, pricing power is strong. Here, HHI equals 2,150, so the industry is moderately concentrated.